Welcome to your Mortgage Insider Update. It is February the 17th. It is snowing in Reno, Nevada. So if you're out on the roads today, be careful. School's closed, but the stock market is open and a very substantial move last week in the 10-year Treasury after first receiving delayed unemployment report came out on Wednesday, actually showing a lot higher job growth than expected in January from the Bureau of Labor Statistics. Initially, that was a negative to interest rates, but after a little time, markets turned and we got the consumer price index on Friday, also for January, came in as expected or a little tamer than expected. So continuing to show inflation is not getting any worse. So we see a big move down on the 10-year Treasury. That tracks pretty well with the going mortgage rates as far as the direction of rates. So we'll take a look at that, talk a little bit more in detail about what's happening. Ultimately, we're seeing mortgage rates are starting to slip back to 6%, maybe even below as we go forward here in 2026. So let's take a look at the charts real quick. And so we can see a steady move down this last couple weeks after hitting a high point January the 20th, breaking above the 200-day average and hanging out there till the end of January. Right as we got into February, started to break lower, had a couple days down. The day before the employment report came out, we actually saw a dip on the 10-year Treasury, a pretty big move. I mean, these are big candles, a lot of movement in those 2 days on Wednesday. Thursday, things settled down after unemployment claims came out, continually high claims on new unemployment and continued unemployed Americans. We saw Friday at either further move down, hitting this 4.05% on the 10-year. Starting this week off, just kind of flat, basically. It started down lower. It's basically hanging out at this 405. You can look back. Last time we were here was back in November. As many times this happens, it dips and then it goes up. So we don't know what the future holds. There could be a little bit of a pullback after a substantial move lower in February. No great new reports coming out this week. We will get another inflation report for December. The personal consumption expenditure, or PCE report, comes out this Friday. Very backward looking since we just got the CPI report for January. Looking at December inflation numbers, shouldn't move the needle too far, only to maybe just sustain these lower levels on the 10-year Treasury. Today, I'm going to talk briefly about the mortgage-backed security prices. Now, these prices work in the inverse to the actual interest rate. So think of an investor, they're buying these mortgage-backed securities, the price they pay. If the price goes down, like it's slightly down today, that actually moves higher interest rates a little bit to the consumer. But we see the price on January 9th was at a high point, which we're basically hanging on to that level right from the first of the year. This was shortly after the actions in Venezuela, and there were some jobs reports that came out early in January that drove prices on mortgage-backed securities higher, meaning the investors had to pay more to get into the security, bringing interest rates down. The price fell in the mid part of January and maintained this level until we just hit on Friday the same high point that we had previously barely touched back in January, early couple weeks of January, and starting out today at that same level. So a positive news on interest rates as markets start to really comprehend what's the effects of AI when it comes to employment, productivity. That's projected that productivity in the United States is going to climb as AI starts to take over, not as much as people's jobs, but definitely the productivity, that everyone can work a little more productive. There are estimates of about 12% productivity boost per employee, which in the long run might mean you need less employees to be 12% more productive. We'll see how that plays out, but the unemployment numbers will continue to be a focal point, while also inflation, as it remains relatively low, not at the Fed's 2% target, but it is likely to get there if productivity picks up and cost to goods and cost to produce comes down with those efficiencies. Make it a great week and reach out if you need anything. Take care.